Part D of Illustrative Example 1 asks us to reconcile the actual result with the budgeted results. So that means we need to reconcile the budgeted profit with the actual profit. So remember, reconciliation is simply, we start with the one value, show all the differences, and then we have to end with the other value. So this is also a valuable test to see whether you addressed all the variances and whether they are correct. So let's just look at the solution. Our budgeted profit, that's what we calculated first, that was 169,600. So we need to start with the budgeted profit, and then we add all the positive variances and deduct all the negative variances, and then that should give us the actual profit, 177,600. So we'll start with budgeted profit, 169,600. So let's just go to a new page, add some space there. So we'll start with budgeted profit, 169,600. And now we need to add all the positive variances. So we can list all of the variances and then show each one. The problem is it's going to take a lot of time, and the mark allocation will probably not compensate you enough for that. So another short way to do that, if you already calculated all your variances, simply add all the variances in the table and then reference it to the reconciliation. So if we look at the quantity variances, so we can add the quantity variances. I'll do it in the same color. So that's material, the negative variance, plus labor, the positive, and then variable overheads, the positive. So that gives us a total or net of 205,000 unfavorable for quantity variances. The price variances, so that's 25 less 30 less 5 less 2.5, so that's 12,500 unfavorable. All right, yes, looks like it. So we've got all our quantity variance. So let's say quantity variances, 2,500. Price variances, that's 12,500. So these are only variable costs. So we must just check whether we had any fixed costs that had variances. They didn't ask us to calculate any fixed cost variances, but there could have been, and that would cause a difference between budgeted and actual profit. So if we look at the information right at the bottom there, we had fixed manufacturing costs that amounted to 40,400, and the budgeted were 38,400. So we had a difference of 2,000, and since the actual is higher than the budgeted, this would be an unfavorable variance. We spent more than what we should have spent. For fixed admin overheads, they said it amounted to 32, which was in line with the budget, so no variance there. So the only variance was our fixed manufacturing overheads. So you'd need to do this calculation somewhere here. So I'm not going to do the calculation again. So fixed manufacturing overhead. So maybe let's do it. So that was 38,400 less 40,400. So that's the budgeted and the actual. And our spending variance would be 2,000. And that's also negative. So all of these are unfavorable. So that means our budgeted profit would have been reduced by all these negative variances to get to our lower actual profit. And then the only other variance was our selling price variance. That would definitely cause a difference between budgeted results and actual results, and that amounted to 25,000. So we did that up here. So 25,000. And that's favorable. So just a note here, it's a good idea to make references here, so the calculation. So if we do the total quantity variance, just go and reference it there where you did the calculation. Same for price variances. So we'll just put a reference there. Fixed manufacturing overheads, we did the calculation right there, so that's not necessary. And then sales price variance, again, just a reference to the calculation. Otherwise, your marker will not know where these values came from. The safer way would be to list all the variances again, but that will waste a lot of time. And if you already calculated them neatly under each other, then you can just simply add them up and then reference the calculations to the totals here. So then we can add up. So this would be our budgeted profit, less our quantity variances, less our price variances, less our fixed manufacturing overhead variance, plus our sales price variance. I'm just going to check this with you so that I make sure the calculation is correct. And that will give us 177,600 actual profit. And at this stage, you really hope that that total agrees to what you calculated before. So let's find the actual profit calculation. There we have it, 177,600, and that agrees to our reconciliation, the total at the end. So you know you didn't make any mistakes in your variances, and you know you included everything in your reconciliation. If you made a mistake here, you could go back, but don't waste time going back if you've run out of time for this question. Rather go on to the next question, and then at the end of the paper you might come back and see, is there anything that you missed out on? So this is the reconciliation. You start with the budgeted profit, you add all the positive variances, you deduct all the negative variances, so that means sales and cost variances, and that'll give you the actual profit, which you can then agree to your actual income statement.